Hey guys, after watching this video, you're going to be able to understand what a REIT is and why you should invest in one. We're going to cover the types of REITs and the most efficient structure in terms of taxes that you should use to actually go about investing in a REIT. We're going to be able to understand what metrics to use when actually assessing and picking a good REIT. And to round it off, I'll give you my top 3 picks for REITs in the UK. If you're new to the channel, my name is Jag. I post all kind of videos on the stock market. If you're into that sort of stuff, then make sure you hit the big red subscribe button. Property. Like you, I have been told that the best method to preserve and build your wealth is through property. Well, considering that 256 billionaires in the world actually derive their wealth from property, this statement cannot be too far off. In fact, individuals have not only become wealthy through property, but have found it a good way to actually preserve their wealth. Bill Gates, for example, one of the most richest men in the world, the founder of Microsoft, has quietly acquired around 250,000 acres of farmland. In a similar case, the founder of Amazon, Jeff Bezos, has acquired around 420,000 acres of Texas. To put that into perspective, the average house in the UK is 1/10 of an acre, and he has acquired 420,000 acres. So it's not a surprise to think that property is a great way to amass huge amounts of wealth. But property is expensive and puts 85% people off from actually getting involved in the property market. You need huge amounts of cash deposits to actually get involved, to actually buy your first property. And even if you want to go into developing a property, then you need even larger amounts of cash. But the barriers to entry, financially speaking, are quite high. The average house in London is actually £485,000. So if you want to actually buy a London property, you're going to need around £121,000 in cash deposit. That's not considering legal fees, broker fees, taxes, and that's just considering buying a house. Big property tycoons gain the wealth from actually developing and owning huge amounts of commercial real estate. This includes owning shopping centres, retail outlets, hotels and more. There's even airports that are then developed by big property tycoons. But hey, how are you going to actually come about owning and developing these massive projects when you can't even get together a cash deposit for a house? Well, this is where REITs come in. REIT actually stands for Real Estate Investment Trust. They first came together in the 1960s in America, but now you can find these investment trusts all over the world. They can be bought and sold like any other stock on HL, Trading 212 and Free Trade, to name a few. Just like buying a share of Apple allows you to own that particular part of the business, buying a REIT allows you to own a share of property that the actual REIT owns without the hassle of legal fees, capital requirements and other management related issues. Buying a REIT allows you to gain a share of the income the actual REIT generates from renting out its property. For most of my audience is from the UK, you ought to know what actually makes up a REIT in terms of what rules are there for the UK for a particular REIT, so you actually have a better idea of what you're actually getting into. Before a REIT can be listed on the London Stock Exchange, it has to meet certain criteria. Now, these are designed to protect shareholders. Firstly, at least 75% of the REIT's assets must be directly into property. This means that they can't be in a position to hold a large amounts of cash, and they constantly have to be invested into the property market. The second rule is that a REIT must own at least 3 properties, and not one property should make up 40% of the REIT's value. Number 3 is that no more than 50% of shares in a REIT should not be held by 5 or fewer people. This is to make sure that not one person is actually making the huge decisions in the day-to-day operations, again to protect shareholders of the REIT. The final rule is that 90%, yes 90% of the REIT's income has to be paid back to shareholders, i.e. if you own the REIT, you are the shareholder, so yeah, 90% of that REIT's income is going to you, which presents a great alternative to actually owning dividend stocks of companies. There are 2 types of REITs in the market. One is equity REITs and the second is mortgage REITs. Now, most REITs will fall into the equity category. Equity REITs actually focus on the rent collected from renting out these properties to tenants. These can be big apartment complexes, residential homes, and shopping malls, to name a few. It's what you would expect when you're actually investing in a property REIT. Mortgage REITs are able to provide mortgages to residential and commercial ventures. These types of REITs are actually split again into different categories. You can find REITs in the hotel space or the data center space, or REITs that look at retail or warehouses. So why add REITs to your existing share portfolio? Well, investing in property usually requires a large amount of cash, with large commercial developments costing millions of pounds, which is frankly not that achievable by the average investor. With a REIT, you can get exposure to the benefits of property, i.e. collecting of rent, without actually putting up a large deposit up front. In fact, with the introduction of fractional shares by brokers such as Trading 212, you can actually buy into property for as little as £1. As well as this, REITs are professionally managed, which means that you don't have to deal with issues that actually come with maintaining a property. Like if you had bought a property yourself, you might have tenants calling you about boiler replacement or some other residential issue that came about. With a REIT, it's all taken care of by the management team behind the actual REIT. Also, as the rules of the REIT require it to own multiple properties, they are pretty much diversified already, with each REIT owning multiple properties in different areas of the UK or even internationally. Therefore, again, you're diversifying your portfolio. Let's say you had invested in just one property, such as a flat in London. Now, there might be a really rogue tenant that doesn't pay you rent. Now, in that situation, you are pretty much stuck till you get the tenant evicted. But with REITs, since the REIT owns multiple properties, there is a good amount of cash flow coming in to cover bad issues that come about. Another benefit of owning a REIT is that you're diversifying your portfolio. Now, while the REIT is actually on the stock market, the underlying asset that the REIT owns is actually property. So by and large, it gives you a hedge against negative impacts to the wider stock market. If your shares are doing really poorly one day, maybe your REIT, the property market, is not impacted. Therefore, your investments are not doing as bad overall. Rent may be still coming in, and the REIT might still be giving you income. Another reason is that a normal business such as TESCO or Asda, any of these corporate entities have to pay corporation tax to the UK government. This is on their net earning. Then whatever is left over after paying that 19% corporation tax, they can give it to their shareholders in the form of dividends. But then that dividend investor would have to pay taxes unless that investment is actually made with an ISA. For those that don't know, is a government tax wrapper account which lets you invest up to £20,000 a year. Any profits that the ISA actually makes are tax free. A REIT can be actually held inside of an ISA, which makes it a very tax efficient investment. Moreover, a UK REIT does not actually have to pay corporation tax or any tax on its capital gains. And as you can buy a REIT in the stocks and shares ISA, you actually have more money coming in because there's less of the government actually taking bits of the money along the way. How to analyze a real estate investment trust. Once you're ready to invest in a REIT, you want to do some fundamental analysis to make sure that REIT is actually worth its value. Whilst you might do earnings per share and price to earning ratio when investing in shares, these metrics don't actually apply to investing in REITs. The metrics that do apply are net operating income, funds from operations, and adjusted funds from operations or adjusted FFO. Now, as this video is just an introduction to REITs, it's not meant to give you a technical analysis perspective. But if you want to see that type of video, then let me know, drop it in the comments, and I'll gladly make that for you. Now, I have the mindset of a long-term investor. Before investing in a REIT, on a fundamental basis, you should be trying to understand whether the REIT sector is actually going to be impacted by macro environmental factors. In other words, what are the long-term prospects of that particular category? For example, if you're looking at retail REITs, you know that everything's moving online. So there potentially could be an adverse impact to your retail outlets. There's less demand in the high street, so retailers may struggle, and therefore you might get more retailers actually not being able to pay on time. This will fundamentally impact your business because there'll be more empty shops, and therefore your actual value of the REIT may fall. At the end of the day, there'll be less cash to distribute to its shareholders, so you'll be getting less cash for that particular investment. So looking at it from this angle, you might be considering the potential forecast for that particular retail REIT is actually a lot lower than it is today. Rather than looking at shopping centre or retail REITs, it might be worth checking out REITs that centre around warehouses or data centres. As demand for online grows, you need more warehouses to fulfill demand for distribution and packaging. You also need data centres to actually handle and process all the traffic that the website actually generates. Therefore, these REITs may be a better long-term investment compared to the traditional shopping centre and retail outlet REITs. Let me run through another example. So you have office building REITs. As there's going to be more individuals working from home, there may be less companies wanting to actually lease out an office. We have found out from 2020, companies for the most part are able to work from home, and employees are actually more happier for the most part again from working from home. Companies are happy because of the productivity that has actually been generated by the employees that are actually working from home. So there's actually less of an incentive for companies to actually shift to an office. After all, they are going to be paying the rent. Therefore, as there is less demand for office space in the future, office space REITs may decline in value, as there will be less value in actually owning an office building. Now you can buy REITs on Pre-Trade and any other good broker. I have links to these platforms in the description, and if you sign up using my link, you'll be getting a free share valued between £2 to £100. But whatever platform you choose or are using, you might want to consider actually putting a REIT in an ISA investment account. As I said before, an ISA acts like a tax-free wrapper for your investments, and the only condition is that the maximum you can deposit in one financial year is up to £20,000. If you buy into a REIT outside of an ISA, then you might be subject to other taxes such as capital gain. The rate you will pay will actually depend on your wider income, so there's no brainer when putting a REIT inside of a ISA. With that being said, let's go through my top 3 REITs in the UK. First, we have Tritex Big Bulk. Now this REIT seems to have long good term prospects, as they provide giant warehouses for companies like Amazon to actually deliver parcels and for packaging purposes. Amazon and TESCO both rent out big warehouses from Tritex. Effectively, if you buy this REIT, Amazon and TESCO are actually paying you rent. Now the second REIT I'll pick is the iShares UK Property ETF. Anybody that's watched any of my previous videos knows that I'm a massive fan of long-term index fund investing. Like the S&P 500, where that allows you to spread your money across different companies, this iShares Property REIT allows you to actually buy into a collection of UK REITs like Tritex, what I mentioned earlier, and British Land. Each pound you invest into this REIT is potentially being spread across multiple properties nationally and in a wide variety of sectors. At number 3, we have Segro PLC. Now this company owns Slough Trading Estate, which in fact is the largest trading estate in the whole of Europe that is under one ownership. Also featured on the UK Office, for anybody that's watched that show. Segro mostly specialises in the development and the maintenance of industrial warehouse properties. Most importantly, despite what's ever happened in 2020 last year, Segro has collected 98% of its rents. I mean, that in itself shows the strong fundamentals behind the company in terms of its management and operating efficiency. They also have demonstrated good historical growth and have good prospects to actually increase their growth as they increase the amount of holdings they actually have. With that being said, guys, make sure you drop a like if you enjoyed the video, as it really helps out the channel a lot. Hit the subscribe and the bell notification icon if you want to be updated on more of my videos. Check out my Instagram and TikTok for more bonus content, and I'll see you in the next video.